But I also picked up on something in one of my notes, and that is that you seem quite concerned that the banking crisis that sort of seemed to blossom in March is not over yet, and that there may be more troubles ahead. Where will it show itself? How and why do you believe this?
I think the headline making part of the banking situation is probably behind us. I think we're now in a position, though, where by and large, there's less capital in the banking system than we might have thought 2 or 3 months ago. And that's heavily because of the mark-to-market due to these asset liability mismatches some banks have had with holding AAA securities and mortgage backs. And so what banks are doing now more quietly is shrinking their loan books, disciplining their loan books, because they have less capital than we may have thought 2 or 3 months ago. And they're also aware that we're heading into a credit cycle. And also there's always a risk with liquidity being drained from the system that deposits will continue to decline. And so it's not a 3-alarm fire. I would call it more of a slow bleed. But the impact is it means small, mid-sized businesses are going to have a harder time and are having a hard time getting loans. Commercial real estate's having a harder time getting loans because the banking system is trying to guard its capital and is being much more cautious about making new loans.
So what you just said there suggests to me, in other words, that banks are being more cautious about making new loans. They are shrinking their loan book. They're maybe applying tougher standards. It suggests to me that you think the banking system is doing some of the work of the Fed with respect to restricting money supply and pressuring inflation downward. Do I have that right?
Yeah, that is true. Here's the issue. Big companies like the S&P 500 don't really borrow that much from banks. It's small, mid-sized businesses that are very dependent on small, mid-sized banks. So, yes, you're right. This is doing some of the Fed's work for it, but it's disproportionately affecting small, mid-sized businesses.
All right. So it seems to me, and I'd be so curious, the leading indicators are all pretty clear. And I think Jeff Gundlach made comments like this as well, that they're telling us a recession is coming. And I understand people, say, well, it's taken a while. That doesn't mean it's coming. Should the Fed be talking more about leading indicators than it does about employment and inflation?
Well, it should be looking at all those things, and it should also be talking intensively to contacts, because at these points of inflection, where we're getting some change in the economy, data is lagging. It's backward looking, and you need to be more forward looking here. That's the reason why I think it'd be wise to take a hawkish pause in this meeting. You want to see how the refilling of the Treasury General account affects liquidity. We have cross currents between the goods sector appearing to be weaker, but the service sector being very, very strong. Also monetary policy acts with a lag. And so, yeah, I would want to be more deliberate here and really emphasize being forward looking. Data dependence is more backward looking. It's a part of the puzzle, but it shouldn't dominate the thinking.